Okay, let's dive into this. Welcome to today's explainer, where we're tackling something absolutely historic. I mean, this is happening right under our noses in May 2026. We are witnessing the very beginning of an unprecedented intergenerational wealth transfer. And honestly, it's an economic event so massive that it's literally reshaping global finance as we speak. Yet, crazy enough, so many families are walking into it completely unprepared. So today, we're going to break down exactly what's happening, why the stakes have truly never been higher, and we'll look at the specific structural tools the ultra-wealthy are using to navigate the whole shebang. $83 trillion. Seriously, just let the sheer magnitude of that number sink in for a second. That's an 83 with 12 zeros behind it. That is the estimated value of the wealth expected to move from the baby boomer generation down to Generation X, Millennials, and Gen Z over the next 2.5 decades. You know, this isn't just some passing market trend. This is the single largest intergenerational transfer of private wealth in all of recorded human history. It's just a staggering, monumental shift of capital, real estate, and private enterprise.
So, to make sense of all this, here's our roadmap for the explainer. First, we'll cover the 83 trillion question, then navigating the 2026 storm and the next generation factor. After that, we'll be demystifying PPLI, looking at the EWP framework, and finally wrapping up with prepare or pay the price. We're going to logically break down this global macroeconomic challenge all the way down to the specialized financial structures designed to solve it. Let's get right to it. Section 1, the 83 trillion question. Right now, across the globe, we've got roughly 23 million high net worth individuals who collectively hold close to $87 trillion. So the question isn't whether this massive wealth transfer is going to happen, it's happening right now. The real question, the one that is absolutely keeping estate planners awake at night, is how much of that wealth is actually going to survive the transfer intact. Section 2, navigating the 2026 storm. Because, you see, this wealth transfer isn't happening in calm waters. Oh, no. We are currently right in the middle of one of the most turbulent, fractured, and just plain unpredictable global macroeconomic storms we have seen in a generation. And this brilliantly illustrates exactly what I mean. Just look at the unprecedented divergence in global monetary policy right now. We've got the U.S. Federal Reserve wrapping up what might be Chair Jerome Powell's final meeting, holding rates steady at 3.5 to 3.75%, but with a highly divided 8-4 vote. Actually, that's the most split decision we've seen since 1992. Meanwhile, the European Central Bank is pausing at 2%, the Bank of England has completely abandoned their planned rate cuts, and the Bank of Japan, well, they're actually on a gradual tightening path. It's all over the map. Add to that intensely divided central banking landscape a severe Middle East energy shock that has pushed Brent crude oil well over $100 per barrel. These energy shocks are just feeding stubborn, persistent inflation globally. For high net worth families, this creates intense, real-time volatility across literally every single asset class they hold. The external threats to wealth right now have rarely been more pronounced. Section 3, the next generation factor. But here's the thing. The macroeconomic storm is really only half the story. The incoming heirs who are receiving this wealth present a completely unique structural risk all on their own. Get a load of this startling piece of industry research. It's a little terrifying if you're a current advisor. Heirs frequently fire their parents' advisors. Yep, when wealth transfers between generations, the incoming heirs rarely just roll with the status quo. They almost always want to start completely fresh. We're talking new advisors, new strategies, and entirely new priorities for their inherited capital. You can really see the stark contrast in generational investment styles here. The older generation typically focused heavily on traditional market returns, but these sophisticated millennial and Gen Z heirs, they are pivoting aggressively toward private markets, AI, sustainability, and transparency. Now, these are incredibly sophisticated allocations, but, and this is a big but, if these modern assets are held in conventional, unstructured accounts, they leave the family completely exposed. We're talking brutal annual taxation, years of agonizing probate delays, and intense scrutiny from global regulators. Bottom line, sophisticated investments demand sophisticated structure. Section 4, demystifying PPLI. So the crucial point is, how do you actually structure this wealth so it survives? Enter private placement life insurance, or PPLI. It is easily one of the most powerful yet completely misunderstood tools in wealth management today.
Let's define this clearly. Private placement life insurance is a highly customized, variable universal life insurance policy. But honestly, think of it more as an investment wrapper designed for accredited investors, typically folks with about $5 million or more in investable assets. What makes it so incredibly unique is that policyholders can take their existing holdings, like private equity stakes, hedge fund positions, or even real estate, and contribute them directly into the policy in kind. I always say calling PPLI life insurance is a bit like calling a private jet a vehicle. I mean, sure, it's technically accurate, but it completely misses the point of what it actually does. While it legally functions as an insurance policy, practically speaking, it's an ultra-efficient vehicle for tax-free growth and seamless portfolio rebalancing. Let's look at the concrete advantages here. Inside a PPLI structure, your assets grow tax-deferred, or in many cases, entirely tax-free. Managers can rebalance the portfolio without triggering a single taxable gain. When the policyholder passes, the death benefit moves to beneficiaries income tax-free, completely bypassing the dreaded public probate process, all while shielding assets from creditors. To put that into perspective, on a $50 million wealth transfer, a PPLI structure can literally save the family millions of dollars in taxes and years of administrative delays compared to a conventional transfer. It's a real game changer. Section 5. The EWP framework. Now, PPLI is profoundly powerful on its own, but its true transformational potential is only fully unleashed when you wrap it within the broader architecture of Expanded Worldwide Planning, or EWP. EWP rests on 6 unbeatable principles. Think of them as foundational pillars holding up the whole strategy. 1. Privacy, minimizing exposure while staying 100% legally compliant. 2. Asset protection, creating a fortress against creditors and political instability. 3. Tax shield, eliminating unnecessary tax drag. 4. Succession planning, allowing for a seamless, probate-free generational transfer. 5. Compliance simplification, harmonizing really complex cross-border regulations like FATCA and CRS into one clean framework. And 6. Trust substitute, acting as a robust alternative in places where traditional trusts are just too difficult to use. It is a complete, highly protective architecture. Section 6. Prepare or pay the price. Let's move to and see how this builds. We've seen the storm, we've seen the tools. Now the final puzzle piece is understanding exactly who needs to implement this sophisticated planning right now. The beneficiaries of this planning are specific but quite diverse. It's absolutely crucial for the entrepreneur operating businesses across multiple countries. It's for ultra-high net worth families who might have real estate in London and private equity in New York. It's for the professional with $10 million in assets who just wants to protect their life's work from litigation. And for sure, it's for aging patriarchs and matriarchs who demand absolute certainty regarding their succession. In the current global environment we just talked about, the cost of holding wealth without this kind of structure is simply way too high. I want to pause right here and ask you a necessary, if slightly uncomfortable, diagnostic question. If you were to pass away tomorrow, how much of your wealth would be lost to taxes, legal processes, and public probate delays? Honestly, how much of what you've spent your life building would actually reach the people you love? And here is the second hard-hitting question to consider. If a creditor or a litigant came after your wealth today, what legally stands between them and your life's work? In an increasingly litigious and totally unpredictable world, having a robust, legally tested asset shield isn't just some nice-to-have luxury anymore. It is an absolute necessity. Think back to that macroeconomic volatility we discussed earlier. If a geopolitical disruption hit your home country tomorrow, say a sudden currency devaluation or newly imposed capital controls, how much of your wealth is truly protected globally? Is your capital safely insulated from the borders it currently resides within? And finally, I want to leave this provocative thought lingering in your mind. Would your heirs receive a clean, tax-efficient, seamlessly structured legacy, or a complex, highly taxed, multi-jurisdictional puzzle that could take them years to untangle? The $83 trillion wealth transfer is already underway. And as we've seen throughout this explainer, structure is not a reaction to global volatility. It is the ultimate preparation for it. So the only question left is, are you prepared?